We talked about the differences between stocks and bonds in our last episode, but did you know that there are different types, classifications within both stocks and bonds? In this episode, we're going to be discussing the different types of stocks so that you can really understand what you're getting into when you start investing into the stock market. This will help you gain an understanding of what those different classifications of stocks are, of the different categories of stocks, and how they might be able to help you pick what interests you the most when it comes to your investment. Snack on this, the flavors of stocks. Let's begin this lesson with the two types of stocks that you're getting into. One is the common stock, one is the preferred stock. Common stock for any stock is essentially everything you can buy and sell on the stock market. So when you invest in a company, when you put money into a company, you're investing typically into their common stock. The common stock gives you a fractional piece of that company. For example, let's say you have a company worth $10, okay? You buy one share at $1. With the common stock, you now own 1/10 of that company. That's what common stocks do for you. You now own 1/10 of the stock, you own 1/10 of the company, but if that company were to fail, you'd lose your dollar. Again, like as we mentioned before, the upside potential is unlimited, but the downside risk is there as well in a common stock. Preferred stock is essentially preferential treatment in the case of companies dissolving, right? If a company is no longer able to perform what it needs to perform, preferred stockholders are the first in line to sort of get their money or get what they're owed. What they're owed in this scenario is just a certain amount of money that's set aside after liquidating their assets. So when a company sells off what it owns after sort of dissolving or closing down, then the preferred stockholders are the first in line to receive whatever sort of payouts they've allocated towards that portion of the stockholders. Preferred stockholders also have the right to receive dividends before common stockholders do as well. Because of these qualities, preferred stock sounds eerily similar to what a bond is, and that's exactly what you can compare it to. Preferred stock in a company is essentially a bond. Preferred stock more closely resembles that fixed income bond rather than the common stock where you're sort of getting a piece of that company. Common stocks are the regular stocks that people buy and hold. Preferred stock is typically like a fixed income bond. Stemming down one level from this, you're looking at large cap, mid cap, and small cap in company sizing, okay? You may have heard these terms before, but we'll break these down for you. Typically, companies are divided into three different stock sizes, or sizes based on their market cap. Their market cap is the worth of all of their stocks combined with the market price of that stock. For example, we're going to go to Microsoft for this one. Microsoft's stock is sitting currently around somewhere $183 a share for the common stock, as we mentioned earlier, okay? With the amount of shares it has times that $183-ish per share, you're looking at a market cap of $1.39 trillion, okay? This is the market cap of the company. Where this factors into is where you're determining the buckets of large cap, mid cap, and small cap stocks. Large cap refers to companies that are typically a bit older and a bit more mature, with about $10 billion or more in market capitalization. Mid caps fall in between $2 billion to $10 billion in market capitalization, and small cap fall right under that $2 billion or lower mark for market cap. This difference goes beyond just the size of the companies. The larger cap the stock is, the more safer and conservative that investment sort of seems, because the company again is mature and it's known to be a leader in its field because of its size. Mid cap and small cap stocks tend to be a little bit more on the aggressive side of things. That's because they have pretty big upside potential if the company does well, but they have that downside that we highlighted earlier. Mid caps and small caps have this feature because they're poised for more growth than the large cap. You can't have a large cap typically go from 10 billion to 20 billion in 5 days. But because of news, overarching market conditions, and what the company is doing, mid caps and small caps tend to increase a bit faster than those large cap stocks do. Now, we move our way around the world, okay? We have two different types of stocks here. We have domestic stocks, we have international stocks. They are exactly what they sound like. If you're in the US, domestic stocks are those companies typically headquartered in the United States. International stocks are international. They're anywhere where the company is headquartered in a foreign country. This definition does get a little bit murky when you're looking at multinational corporations, but domestic and international, the definitions tend to stay the same even when you're looking at those multinational corporations. This is important because you do want a mix of both domestic and international stocks when it comes to your portfolio. This gives you exposure to new and emerging markets, right? For example, if there's a lot of development happening in South Africa, you want to be exposed to that as well, because that will let your portfolio grow with just a bit of more riskier investments. As they say, right, more risk, more reward. You could see more reward from those opportunities, but you may see more downside as well. Investing in just domestic stocks, and in this case we're talking about US only gives you exposure to the US market. You typically do want exposure to more than just the US market when you're looking at your investments, but you don't want to overdo it to where you're only focused on the international stocks. The US economy is typically considered one of the more safer economies to invest in, so you need to make your decisions accordingly. The next classification that we have is a very important one: growth stocks versus value stocks. These are classified as two different investment strategies, but they fall into this lesson because they are also two different types of stocks. A growth strategy or a growth stock is where you look for the company's profits are rising rapidly. Value investors typically look at companies that are inexpensive considering the historical performance of that particular stock, or where that stock falls on an industry average of its peers. Growth stocks are high risk, high reward type of stocks. Successful stocks in this category tend to focus on strong and increased demand from their customers, and they're very good at highlighting long-term societal trends. Keep in mind that although these investments are poised to go up sharply, they tend to decrease pretty sharply as well when the growth slows down. So if a company in its earnings call tells you that it's going to slow down due to X, Y, and Z, and it is a growth stock, you'll see that fall a lot harder than what a value stock will do given the same guidance. Value stocks are seen as more conservatively than growth because they have slower growth potential, but they're usually found at a bargain. These are industry leaders, well-known companies, similar to those large cap companies, and tend to have price stability because of their reliable business models that have usually stood the test of time. They're great to focus on while getting some exposure into stocks, but you want a mix of these growth and value stocks in your portfolio as well, because you want to capitalize on both those things. Now, aren't we going to find ourselves in a huge issue when we're looking at all these different categories and flavors, trying to pick stocks that fit each? No, you don't have to. There's plenty of ETFs, as we've mentioned before, that will highlight these things for you. The ETFs will give you a complete portfolio of the type of stock that you're looking for. For example, if you want to get into the aggressive, more growth stocks in the small mid-cap range, you can find those as one ETF that'll have those companies already partitioned out for you. If you're looking to just get into large cap, you can do that as well. This is made possible very easily by ETFs, so you want to take advantage of getting into those ETFs where you can. Some of the ETFs that we've recommended in the past already have a lot of these strategies incorporated into them. The different flavors of stocks that we've talked about today are incorporated into those ETFs, and you already have exposure into them. One great ETF to look into again is VTI. VTI is the total stock market US index. It doesn't have any international exposure in it, but you're covered from large cap to mid cap, small cap. You have the whole entire US economy encompassed within that one ETF. And it's not expensive relative to the value that you're getting from it. So this week, check out some of those flavors. Look at the ETFs that you want to get into, and we'll see you next week for the next few flavors of stocks. Keep investing.